All right, happy Tuesday, everybody, and welcome to the September Jobs Report readout with Dr. Reilly White of the University of New Mexico. In this monthly call, we discuss the Bureau of Labor Statistics Jobs Report and its implications on your job search and career prospects. Additionally, we also cover a topic of interest that is tangential to the economy. And this month, it's the results of the latest California recall election that we had a month ago and how companies are responding, including Tesla's big move. With us today to discuss is Dr. Reilly White, who, among other things, is an associate professor of finance and endowed Bank of America lecturer at the University of New Mexico. In addition to teaching MBA students, he also serves as the University Outreach Chair for the CFA Society of New Mexico, chair of the Cassidy CFA Scholarship, and advisor for the $3.6 million student-run University of New Mexico Regents portfolio. Prior to his career in academia, Dr. White worked as an analyst for a large Boston-based bank, where he learned a great deal about company analysis, funding, and maintaining ethical corporate leadership. Before I hand it off, we're going to be recording this call. It'll be here on Facebook, and I'm going to go ahead and transfer that over to YouTube later. Dr. White will be answering any questions, if there are any, as he goes, so feel free to share your thoughts in the chat. Dr. White, over to you.
Thank you so much, Albert, and thank you so much, Albert's list, and all of our attendees who are able to make it on Tuesday. I know it is a school night; it is a night of work and toil, but I'm so happy you're able to make it here. I had some last minute. In my role, I'm also the assistant dean at the business school where I work. And so I had some last minute work I had to take care of on Friday night. So I had to move this. So I'm so grateful for the opportunity to talk to you on Tuesday. But here's the downside. We all know a sense of the jobs report already, and the jobs report was not particularly good. And so I'm going to tell you a little bit about what this is, why the reaction was so bad, why perhaps there might be cause for hope, but also some overarching, step back a second. Let's take a look at the actual jobs report itself. Let's see what's happening. Let's see where the economy is headed. And that big picture view becomes really important, particularly as we talk about the trajectory going forward. And so I want, as always, I love questions. I want you to ask questions, Q&A, chat window, whatever you are most comfortable with, you're always welcome to ask at any point in the presentation. Any such thing related to economics, finance, anything that you have an interest in, I would love to talk about. And so anyway, so here we are for the September jobs report on October 12th. That is today. So let's give a sense of this. And I'm actually going to go forward a little bit. And I kind of a little breakdown specific to California in this post-recall election world. Things to consider, things to look at, and also some insights from a recent report that was done by Stanford and the University of Texas, looking at the question of what is the difference economically and politically, policy-based between California and Texas. Now let's talk a little bit about this. So first, the jobs report overall. Ooh, not so good. And to give you a sense of this, the economic consensus was around 500,000 jobs to be created. We created about 194,000 jobs. That is very disappointing. That's like expecting 100 on a test and getting a 40. Unemployment, though, fell to 4.8% from 5.2%. Again, a big jump, but wait, was it because we increased the labor force and added new jobs? No. As it turns out, our labor force also declined by 183,000. And so we had a shrinking labor force. And again, if you look at unemployment rate, it looks at people in the labor force looking for a job, part of the labor force willingly looking for a job. So if you drop out or you retire, you're not in the labor force. If you drop out of the market and you're not looking for a job, you're not in the labor force. And this labor force actually shrunk in September. Now that's a little bit alarming, because one thing that I wanted to look forward to, especially as we kind of had the ramp up towards fall, and this is of a different projection of our COVID economy, was that as schools reopened, we'd see parents collectively getting more back into sort of the saddle, looking for jobs, working in places they were before. And we haven't seen them return at those levels yet. And I think this ultimately is part of that reiteration that we've seen over the last few, gosh, over the last year, basically, where we had such a hit last year to our economy. That recovery period is normally a very, very long time. It normally takes many, many months to recover jobs that are lost. It is much easier to fire than it is to hire. But okay, so let's take a look at where jobs were created and where we actually lost some ground. And that gives us some insights into where the market is headed. Now, we talked about in the last time, if you happen to be there for the last the September jobs report for August, the August jobs report in September, I should say. We talked a little bit about how the COVID cases tend to be reflected in the job market. And we know that when there's a lot of COVID cases going around, employers hire fewer people. And a lot of this is due to worker choice. Workers are watching out for their own safety and not entering the market, among many other factors. And because cases remained high for the last month, we expected that the September numbers would show that as well. And that is indeed what we've seen. We still wanted a little bit higher numbers here, but we are gaining jobs back in areas where we've lost them, particularly in leisure and hospitality. 74,000 jobs back. Good to note that we have some high-paying jobs being added. Professional and business services, about 60,000 across the country. Retail, 56,000. We usually see retail hiring pick up pace as we approach the holiday season. It will be interesting to see how it responds this year. Particularly given the increase in wages and the labor shortages experienced by many businesses across the country. On the downside of it, we lost 144,000 jobs in local government education, teachers. This is significant. Some of that's due to retirement. Some of that is due to capacity issues. Some of that is due to fiscal adjustments. When we sort of were planning the ramp up of hiring, we saw this particular local government sector in education sort of expand in summer in anticipation of greater enrollments, greater students. And what happened was it hasn't materialized the same way. People are, many students still are learning from home. A lot of that is due to sort of that continuous sense of uncertainty around the COVID pandemic. And this is cool. This was true in both public and private sectors. We actually lost 19,000 teaching jobs in private education as well. We also lost healthcare jobs as well. It's been very hard to pick jobs up in a lot of the sectors that are often the most desired by society. Wage growth was robust. And when we think about wage growth as anticipating inflation, what we're going to talk about in the next month, in the first week of November, when we go over the October jobs report, is sort of the inflation, the supply chain issues. We're going to revisit some of these. We have some more data that we didn't have before. And a lot of this will happen. We've seen shortages in the pandemic expand from, in many cases, many different potential sectors down to very few, but very significant sectors that affect a lot of lives anyway. But these shortages are likely to continue in the supply chain in the short run. Now, wage growth, on the other hand, when we think about wages, we're thinking about sort of an aggregate sense of not only just how people are paid, but the demand that is implied by those jobs themselves. And so at the beginning of the pandemic, we laid off a ton of workers in the service sector. Those workers have since come partially back online, but many cases, jobs and small businesses in particular are saying we can't find workers in the same places as they did before. Indeed, people don't stay in the same position. They move on and find other jobs, and you won't come back perhaps to that job you had in a restaurant or a hotel if you left it a year ago due to the pandemic. And so the thing is that employers in an effort and this is particularly true of non-supervisory employees in service sector occupations, are indeed raising wages. We saw a growth in the last month of about 19 cents per hour on average. That is sizable for a month-to-month growth rate. And what we see is what can propel inflation in the long run in a meaningful way is wage growth. If you pay people more money, companies can charge higher prices for things. And so, or you can look at it the other way and say that, well, if we pay people more money, the cost of those businesses get passed on to customers in the form of higher prices. Either way, you have arguments in favor of the generation of inflation. And that's what we'll also talk about in the long run, is how long will inflation be here. And this is really relevant because when you think about what the Federal Reserve has said or communicated in the last month or two. The Fed is saying, the Fed again sets one interest rate, overnight lending to large banks. And this rate has been kept at near zero for the last couple of years. And they're looking at a number of other monetary policy measures that they took to help stimulate the economy, such as buying mortgage-backed securities, buying bonds, doing other things to help prop up our markets. In the optimistic hiring days of 2 months and 3 months ago, the Fed was kind of saying, well, wait a second, it's about time for us to taper these and potentially raise rates. Now, because this jobs report is not good, and again, the Federal Reserve in most of its history has had this dual mandate where they try to maximize employment at the same time while keeping inflation close to 2%. And inflation is much above that amount right now. And employment is far from being full employment yet, even though our unemployment rate is 4.8%, the decline in labor force. There are unhealthy aspects to this economy that the Fed has addressed. And so the thinking is now maybe the Fed will be a little less keen on being more restrictive in monetary policy because they worry that, say, an increase in rates, other things as well, anything where you restrict the monetary supply may put a cap on economic growth perhaps too soon. And so then you have kind of this waiting game. Do we raise rates to potentially lower inflation, but also cap economic growth, or do we keep rates low and allow inflation to continue, albeit at a manageable rate? And how long can we sustain those things? And this is really what the next couple months are really about. And that's fundamentally the story. Now, the labor force participation, and I told, you guys remember, I was very interested in looking at how the participation rate was affected as soon as kids went back to school this year. And as it turns out, our labor force participation is dropping slightly. There's still so much uncertainty and viral related conditions that are happening in the market right now, that this is still far below our analysts' expectations of 500,000. This is a big section of uncertainty, but I will qualify that. And I will note precisely why we don't necessarily have to view that as negative as perhaps we have been, but I am watching that number significantly. So let's look at the sector breakdown that we saw. And so again, sort of the numbers that we had, looking at leisure and hospitality, plus 74, education, minus 180. Who doesn't need education? Speaking as a professor. But manufacturing, you're up 26, construction's up 22. Those are good, positive numbers on this. This wouldn't be a terrible jobs report in a good economy, but it is not, it is not a recovery jobs report. And I think that's important. And again, looking at that educational piece itself, this is a huge number. A huge amount of educational losses were seen in September, as those numbers came in on who is available. And so one way you can also look at this is the question of how have workers responded to this. And we talked about how last month there was the greatest number of job openings ever in US history. That has since declined a little bit. Since we reached that peak last month, it's since gone down a little bit. There are fewer job openings this month than the previous month. Still an extraordinarily high level of job openings relative to sort of the long-term average. And then we look at individual sectors. And so what this does is it figures out, so workers in this country, most workers, about 3/4 of workers, work somewhere around a 9 to 5 job, meaning that you start work between 6 and 10 a.m. About 1 in 10 workers start work between 12 and 6, a bunch of other data, but you get the idea that depending on the sector you're in, what represents your job and your shift can be drastically different. And so if we look at the total number of shifts that employees have worked across the country, you might argue and say, well, look at this. Are we back to where we were before the pandemic? And the answer is no. In the public sector, we saw an increased number of shifts, particularly in education as we went back to school in August and September across most of the country. But we're still trailing below about 80 to 90% the level of where we were prior to the pandemic. And one often cited instance is many economists feel this might be due to workers being hesitant to take on additional work for fear of the virus, for fear of health concerns, especially since this is affecting a lot of face-to-face type jobs, service sector, healthcare, et cetera, et cetera. If you look at this, we saw huge declines across the board right after the pandemic. This recovered and it remains steady from basically July of 2020 until today. And so you're either comfortable with your job. We haven't seen a return to the same number of labor shifts taken that we've seen lately. Now, okay, so I'm looking at this. what's a different way we can look at this number? You might argue, for instance, looking at these numbers, well, Reilly, are there a lot of people that are employed part-time for economic reasons here? And are people taking fewer shifts because other shifts aren't available to them? And I would point this out, relatively speaking, if we look at questions of how many people are part-time for economic reasons, how many people are looking at would prefer to have a full-time job, but they can't because the economic availability of those jobs is non-existent. And these are not scaled numbers. These are actual, these are actual part-time for economic reasons numbers. These are, 2 million at the bottom of this 0, 2, 4, 6, 8, 10 million. And notice that, and I want to really point this out as sort of a silver lining to the job market's progress. The dates at the bottom range from 1969. This is from Calculated Risk, a very cool and interesting economics blog that is always updated on a timely basis. But this sort of resulted in sort of what I wanted to get at with regards to the question of part-time work. So during the Great Recession in 2008, 2009, we had about a little bit more than 4 million people were part-time for economic reasons. That shot up during the Great Recession to 9 million. And really, if you look at the period of 2009 to 2019 as a 10-year gradual recovery period, which in many cases it was, it took 10 years for those numbers to drop back to 4 million. And now, during the pandemic, we had people part-time for economic reasons shoot up to a higher level, 11 million. The advantages of economic stimulus in combination with a very robust PPP lending program to small businesses, in part to a number of individual factors, allowed the number of employees who are part-time for economic reasons to drop within a year down to about 4 million. And so this means that, and this is a very interesting key, is there are basically as few workers part-time as are looking for full-time work, but seemingly trapped in part-time work as there were before the pandemic. So in that measure, we have essentially recovered. And I want to reiterate, that's very, very important. And we're at a level that we saw similar to the mid 2000s, right? So about 4 million. And again, we have a higher population than we did back then. And so overall, as a percentage of the overall workforce, this is a little bit lower. And that's a very positive sign. Now, the question is, of course, so the people are working, they're working full-time or they're not working in the market at all. And that is a more dire concern. But regarding part-time work, this is a little bit of a silver lining. Now we go about this and let's look at the actual labor force itself. We have the labor force, the participation rate in general from 24 to 54, as well as the employment to population ratio. And if we look at the numbers, this 25 to 54-year-old age is always classified as sort of the prime working age, right? After 54, meh. Before 25, meh. But when you're 25 to 54, as many of us might be, that's a big range. We represent sort of the backbone of economic growth in the country, et cetera, et cetera. And so what you have here is you have sort of a long-term tendency to look at the participation rate relative to this total size of the labor force. Beginning in the 60s, 70s, 80s, 60s, 70s, 80s, and today. It's like your favorite, it's like when you end up on the FM radio somewhere and looking at these, looking at numbers. But we saw an explosion of the amount of women that are in the workforce. And that was a huge achievement. It actually excelled and even beat many European countries, many other developed countries globally. And so that sort of increased up to the point around 1990 where it leveled off in a very substantial way. Now, since that time, we've had a difficult time recovering. Obviously, we do really well prior to a recession. During a recession, our employment drops. Prior to recession, it peaks, then it drops, then it drops, then it drops. Between 2008 and 2020, it took us a very long time to recover that labor force participation rate, a very, very long time, a 10-year period. Here we have recovered, although we've stalled out a little bit. We've recovered faster than we did in previous years. So this is, again, the trajectory in aggregate is good. Focus on the long-term trajectory over the short-term benefits, and it looks like we might be doing okay. But the hard part is there is still so much concern around the pandemic, so much concern about the way it's affecting a lot of economic livelihoods, that there is still an extant question. What's going to happen next? And but I want you to step back and say, look at this. We had a colossal recession last year. The recession was not less severe because it was shorter. I know we can argue about this. It was not less severe because it was a condition that that we took upon ourselves to protect public health. And it affected a great number of workers. And there's no easy way to say that once we start, or once a recession happens, it takes an age to recover, and those costs are always immense. But we are still tracking relatively well in a very substantial way. And I want to reiterate sort of that larger perspective here. Okay, questions on any of this so far? That's the first 20 minutes. All right, so I want to go down, and let's go down to the Bay Area a little bit, and let's check out the labor force data. As you know, BLS data on the labor force is a little bit about a month delayed when we think about, when you talk about metropolitan areas versus national areas. And in the Bay Area, unemployment rate, as we anticipated in August, dropped a little bit, but so did the labor force. So we're still seeing some of those chronic issues that we see in the rest of the country. 2 points of hope: information jobs increased, professional and business services increased. Now, if you're a fan of Albert's list, like I am, one of the things that you care about most is you might have a job that falls particularly in one of those two sectors. And what we saw in August was they still added jobs in those two areas, particularly in professional and business services, which added about 7,000 jobs locally. Information added almost 1,000 jobs. Again, steady, nothing absolutely insane about these, nothing's gangbusters about our growth rate involving information sector, but we're still growing. And I think that's really important. Leisure and hospitality has been historically the biggest driver of an engine of growth in the recovery because it lost the most jobs. That kind of stalled out between July and August. Our numbers, the numbers for leisure and hospitality, were actually lower than it was for the number of new jobs added in professional and business services. That is a substantial differentiation. Other services had also did well. Manufacturing, not so well. Trade and transportation, that was basically level. Financial activities added about 400 jobs in the Bay Area as well. So overall, you have a sense that at least information and professional services were robust in those 2 months, and that was a strong case. Particularly given that we've seen sort of a tendency. We have a lot of headwinds economically. We have a declining value of the dollar. We have a sort of systematic, our trade policy, is always, it's a little bit more protectionist than it was. These two administrations are both relatively protectionist relative to prior administrations. So there are some headwinds that prevent economic growth, particularly for trade hubs like the Bay Area that are heavily connected internationally through ports. And so it becomes a really big question as to where we go from here. So, okay, so that's kind of the good sign when we talk about the Bay Area. Now, let's drill down a little bit, and I want to talk to you a little bit about sort of the California report. And so I want to talk to you a little bit about some aspects of the California economy, which are interesting, some results of a recent study, and kind of give you an overall perspective on this. So as you know, of course, and we talked about this beforehand, and Albert was very kind, and he said last month, he's like, it'd be very interesting to see something about, the economic effects of, say, recall elections. And because recall elections themselves are very expensive things, indeed, what a $276 million price tag under one estimate, perhaps higher than 300 million on another estimate. They're very expensive things. They hire a lot of temporary workers, which can be potentially good for the economy. And you might argue and say, well, Reilly, are any of those August jobs tied to the recall election that you pointed out before? And I would say certainly a proportion of them might be, particularly in the other services sector that might have profound. It'd be interesting if those jobs drop off now that we're past the recall election. So you've seen this in the news 100 times, and some added points to this as well. Regardless of whether you voted for Newsom or Elder or anyone else in between, or any of the other list of candidates, I don't know if Albert was on the list of candidates, but if you voted for any of those candidates and you had a chance to go through this election process, it was exhaustive. You had a tendency, you might have been looking at different issues. How did you? Albert, he wrote himself in. Albert wrote himself in. He got 4 votes. That's great. You outperformed me this election cycle, Albert. So I'm very pleased. I always tell myself, I'm competing for dog catcher in Bakersfield. But California economic overview. Remember, the state has $2.8 trillion of gross state product. That's the size of the overall economy. The growth rate between 2014 and 2019 actually was one of the highest. It was the fourth highest across the country, the rate of growth. It is the largest single economy, but the rate of growth was high. That boosted the average per capita income of Californians to be significantly high, but we'll explain the other downsides of that. Almost 40 million people, 1.6 million businesses in the state. And again, the business growth rate between 2014 and 2019 was about almost 3% per annum. That was about seventh, and we look at 50 different states. And this data is from IBIS World. So, and then of course, you probably saw in the news, Elon Musk, of course, responding to a California lawmaker tweet, perhaps, but in reality, we know he's been kind of toying with this idea of moving to Texas for a while, said, you know, he complains about California regulations. You put, and despite the fact that Tesla has become sort of a giant company by any standards, a top 10 largest company by market capitalization in the world, it is still a question. He's moving the headquarters to Texas, not abandoning the state. Those jobs are still there, but at least involving those high-end corporate jobs. And seemingly every time this happens, you have this, it's an existential crisis. Is Bay Area losing its luster to other things? And the answer is a little complex on this, but let's dive a little bit deeper and take a look at this. And let's take a look at what California economic policies, how they stack up to Texas. So, COVID-19 economic impact. So one big thing is, what I like about this, IBIS World, there's a whole bunch of different reports out there that looked at the exposure of an individual economy to COVID. California was more exposed than the average economy, about fifth in the country, just because you had a lot of high accommodation and food services jobs, high arts, entertainment, and recreation, huge numbers of employment in areas that are highly affected by the virus. If you look at sort of a percent of total California unemployment, most jobs had medium, high, or high exposure to, meaning literally 60%, to disruption, to being disrupted by COVID-19. So, yes, Albert's List members debated the California exodus this week too and how real it was. So this is good. So let's talk about the economics behind it. I like this. It's timely and it's relevant, and I have a feeling this might be a little interested in. So basically 13% of all employees in California are employed in sectors that have low exposure to COVID-19. But you're like, okay, so let's drill a little bit deeper. It's important to know your own economy. And this is, if you know, I was trying to think of puns that involved the word sector, and all I thought was the SVG, writing it out and then replacing vector with sector. So anyway, so I apologize for the poor quality of this, and I realize I'm like, maybe if anybody understands this pun, it'll be Silicon Valley. So GDP by sector. So if we look at where does the California economy have its growth? Where does it exist? When we think about the size of different aspects of the California economy, what are we talking about? And I'm showing you this slide to reiterate just how utterly diverse the California economy is. So let's talk about the information sector. The information sector, the jobs at which we are very focused on, the high profile jobs, when Congress debates Facebook, when Elon Musk tweets about his move or his other shenanigans, we're thinking about the information sector. And you're like, well, Reilly, I know Tesla's a car company. I'm like, yeah. All of that's based off. It's really interesting because from a sector standpoint, you can make a case to include it in information technology. All of this stuff that exists out here, much like many solar companies are actually grouped in there as well. Information as a whole represents about $288 billion dollars to the California economy on an annual basis. Now, the growth rate for the information sector is higher than almost every other sector. There's two others that have beat them, and I'll explain what those are. The growth rate between 2013 and 2018 in the sector was almost 10% per annum. That is an incredibly high number. It's almost an unsustainably high number. And so you're reaping a benefit here. Ooh, Joanna has a question. 3 of my neighbors moved recently. 1 to San Diego, 1 to San Jose, and 1 to Sonoma. This is great. So Joanna brings up a really good point as well. When we think about people moving in an exodus per se, it becomes an exodus to other parts of California most often. And we have the proof for that as well. And I'm going to show you a chart in a second, Joanna, because I love that. I love that point. So, so the information sector sector represents about $288 billion of the California economy. And again, and this is the thing, you would never guess this if you are focused on the internet information sector itself. And I reiterate this, and this is sort of that disconnect a lot of people have. There are two bigger sectors than that in California: manufacturing and real estate, which includes rental and leasing. Real estate, you're like, yes, I have Scanzillow and I can verify. It doesn't need to be a very big sector to know that I see how it generates $504 billion of annual GDP. Manufacturing about 321 billion. Professional technical services, another huge part of Silicon Valley, 262 billion. Healthcare, wholesale trade, finance, retail trade, construction. The thing is it is an incredibly diversified economy. It's diversified by most state standards. And the thing is to not be focused so much on what happens in the information or even the professional, scientific, and technical services element. That said, that represents a huge engine of growth for the state. And I don't want to belittle that. Still, if we're looking at annualized growth rate between 2013 and 2018, number one sector for growth was information. The number two sector for growth was construction. And the number three was actually accommodation and food services, a sector particularly hit hard by the recent pandemic. Where we've seen losses, where are there fewer jobs and fewer economic growth in certain areas? Agriculture, forestry, fishing, hunting, as well as mining and oil and gas transactions. But again, these represent sizably, significantly smaller pieces of the economic pie for California. All right, so you're with me on this. So diversified economy, very good, very good. And so when you think of placing Tesla within this context, you're still looking at a small piece of a sector that is still very robust in the state. Now, the question is where are people actually working? And so here's the economic size of these different levels. Let's actually think about where people are physically employed. The single biggest, so healthcare, for instance, not the biggest driver of economic growth, about $187 billion of GDP annually comes from healthcare in California. If we look at it from the perspective of the number of employees, it is the largest by far single sector for employment in California, 2.7 million people. And that sector has grown about 3%. Now I want you to pay attention to these growth rates. So there's a difference between when we talk about the growth rate of employment, the number of people working in that job, and then the size of the GDP growth. And when GDP growth outstrips the number of people working, that means, at least hypothetically, there is more money to go around. So when GDP growth is higher than employment growth, it means that it doesn't say anything about where that money goes, whether it's a high level of inequality or any aspect about where the money ends up. But it does mean that employment lags GDP growth. And that's the case for most sectors many of the time. And that's the case for the last 100 years. And that's why we look at different sectors becoming enriched as time goes on and there being more money, so to speak, floating around. Now, retail trade, on the other hand, saw a decline in a very level framework all the way back to 2013, and even before then. So retail has been a huge employer of Californians, but it's been very stable. It doesn't have the growth rates. It was, of course, very prone to the technological revolutions of the last 10, 20, 30 years, particularly as we approach e-commerce, other things like this. So consequently, the retail trade numbers never recovered. Professional service growth has been robust. The highest employment growth we saw in the years preceding the pandemic actually occurred in transportation and warehousing. Things that you wish we had now in this era of COVID-based shortages, at 14.5% annually, which is huge growth of employment. But on the other hand, you still have construction at 4.6% annualized. You had accommodations at 3.8%, management of companies, and then information at 3.8 and 3.2. Again, sizable concerns, but look at where everybody works. There are over 1.2 million construction workers in California. There's 1.3 million transportation workers. Get a sense, 1 million finance people. Can you believe it? Is that enough? Is it too much? It's 1 million and one too many. So let's go on here and let's take a look at this. So what happens when we think about the big picture here? And this is a study I want to point you to. This was released back in September, and it was a joint project between Stanford and University of Texas, because the Texans wouldn't trust the California researchers, and the California researchers wouldn't trust the Texas researchers. And so when you think about ex-residents and think about where people go and what does this mean, let's start off with talking a little bit about some of the mythos behind some of this, the findings of the report, and what they might mean for you. And I like this report so much, and I encourage you to look it up. It is very accessible, it is very readable, and I think you'll find some very interesting points on this. And it's based off of a lot of good data and very, very talented researchers. And I highlighted some things here because I think they're interesting. When Californians think of Texans, apart from not the people themselves, but say the conditions, the economic conditions of Texas, one of the first thing that comes up is just how much cheaper real estate is. And indeed, if we look at the distribution of houses in 2019, California, if you're talking about where even in 2019, a full 1/3 of housing stock in California was worth more than $750,000. You're absolutely right, Albert. We're going to get to the taxes part. I talk exactly about those taxes. Yep, there it is. Yeah. Where did maybe I left it out. Did I leave out the tax slide? I think I left out the tax slide. Oh, fiddlesticks. But yes, your point is I'm like, no one will care about taxes. Albert asked a question about taxes. So actually, let me grab it for you here because I think it's important enough to talk about. So if we think about this, let's bring it here. Let's look at the revenue per resident despite this, and I'll drop this in here. Do a little street finance here. We're going to rock and roll this. Here we go. So I got another one for you. So let's talk taxes. Look at this. It's quick. So yes, so if you look at just the blue lines, this is California. Obviously, on the right-hand side is more expensive. Most houses are very, very expensive to a level that Texas just doesn't have. The greatest percentage of housing in Texas in 2019 fell between 100,000 and 199,000. What does that buy you? Like 1/8 of a parking space, perhaps. It's a very challenging. Oh my goodness. So what happens? What do you do with this? And then to Albert's point, that revenue mix is also a little bit different. And so if we don't look at just housing and actually look at a little bit on the revenues, and I'll zoom in here for the cheap seats, we can actually look at the revenues per state resident in 2019 based on the income that they bring in, the taxes that they pay. So obviously Texas with its non-existent income tax, you don't bring in any money from a Texas income tax. California, you spend about $3,000 on average per year. Property tax, higher in Texas, as to Albert's point. Not incredibly, not like 4 times higher perhaps, but you do bring in much more in Texas than you do in California. Sales taxes are higher in Texas in general. But then you also have different things. You also have other sources of revenue for the state of California are more diversified and consequently are broader. Federal transfers to state and local are higher. Employee retirement revenues are higher in California. Current charges for government services are also higher. So all those things become key components. Now, if we actually look at sort of the California state and local expenditures per state, one of the things that I want to bring up, and this is the interesting part about this finding, and this was done from Stanford, so you have to put on your Stanford hats here. Stanford hats are available in the gift shop at Albert's list for $800 a hat. But figure for California versus Texas state and local expenditures, we're looking at per capita, any way you slice it, California spends more money on stuff than Texas does. Now, some of that is based off of real economic concerns. In places that are more expensive, you spend more money on things, very common sense stuff. They did note in the report that California spends a lot more on education than Texas does, but the results are not significantly or statistically better than Texas. And then this becomes an interesting argument, right? And especially as we look for efficiency in public policy and questions involving about, say, expenditures and resources. Often it seems like a good idea to make expenditures go to things that we all care about collectively. Sometimes there is what we call a declining marginal benefit, meaning that the more money that you throw into something, the less of an actual benefit it actually produces. And so while it might be likely, so if I start off on something and I say, I want to raise I want every graduate, it's a really good question. How much money would I have to throw at Sacramento to get every one of their graduating high school seniors a perfect score on the SAT test? And at some level, you can throw tons of money this way and provide tons of resources, and you'll reach some probably maximum amount of educational efficiency. And so it's hard, and I think the discussion that we have in the next 10, 20, 30 years revolves around how effective certain monetary incentives are relative to other monetary incentives. And so always be critical, look at this data, and always double check what's been published in other research work on this. Social services. California spends a lot more than Texas. Texas has a lot more people that are uninsured than California does. Public safety and environment and housing, employee retirement, transportation, all higher for California, as well as utilities and other expenditures. So in the sense here, you get the idea that, well, this is a little bit expensive. And electricity being on isn't guaranteed. That's a good point. I'm glad you brought that up, Albert, because I also have a chart about electricity. So in this growth, let's talk about, so I'll talk first about net immigration when we think about these questions. So in California, we look at, say, this is net immigration, which includes not just domestic immigration, but also international immigration, and that differentiation is key. So obviously, when we take out international immigration to California, we are a little bit underwater. There's more people that leave than arrive. If we include net immigration, we still end up on top. Now, relative to Texas, this transition is actually a fairly recent one. About 2018 or so, the lines actually cross. Texas has always attracted sort of a steady growth of immigration to the state. California, on the other hand, had a huge amount of growth, especially prior to 2005. And then since that time period, it's since kind of gone down in a very gradual way, and then very rapidly as we approach 2020 and 2021. And some of that is due to the economic factors at play, as well as California's moving to other states, retiring, other things. When we think about energy and the environment, it is critiqued. California has a worse air quality than Texas in aggregate. We look at the percentage of electricity generated from wind and solar. California is about 21%, Texas 18%. This was again 2 years ago. This is outdated already, but that was the most recent data that they compiled for this report. And then they looked at power outages over a 16-year period and found that on average, California had about 3 times the level of power outages as Texas did, and almost the same relative to the United States. And we look at average electricity prices in California, they're about 2.5 times more expensive. These represent real cost considerations for businesses, particularly as they grow and establish and become part of a market. Now, on the key takeaways from the report, and this is copied directly from the report, and so I was very interested in this. Both states have a lot of good aspects to them. Population and employment grew most heavily in Texas, but per capita income and GDP soared in California. Now, the other thing when you think about this is that you have very different, and this has been discussed most recently it's all over econ Twitter and other things. We think about the question of, California, of course, has a lot of ways it could improve, as does Texas. So California stood out for, in this report, its high level of homelessness and its low air quality. And Texas, on the other hand, had a larger share of residents without health insurance than the other state. And regarding to California's numbers, when we look at homelessness is indeed correlated highly in other papers with the price of real estate. And so anywhere where you have expensive or inaccessible real estate, you tend to have a greater homeless population. And homelessness, of course, and this is always given as sort of a question, and you look at different cities in Texas, and one report looked at how Austin had a greater homeless problem than other parts of Texas. And obviously on one level you have the question of how do we treat and deal with mental illness in various parts of the country. But on the other hand, you have the question, is Austin worse at this than other Texas cities? No, but what Austin has is a more restrictive zoning structure and more expensive real estate than some other Texas cities. And that contributes, of course, to a greater levels of homelessness. And so it becomes down to a few economic factors that become really, really important. The surefire way, another report looked at the ways that housing was segregated in 2 different cities, in Boston and in Houston. And although Boston was more expensive and more prosperous by any metric of the term than Houston was in this particular report, their neighborhoods were also more segregated. And a lot of this was attributed, at least a majority of this was attributed to zoning regulations and zoning restrictions that prevented the building of new units in areas that could use more units. And so places where California and Texas could learn from each other, right, become a really important question. And this is really, really interesting. Albert points out that it seems like no matter what state you go to, you get something, but you have to give something up. Absolutely true. Everything depends on individual preferences, and what keeps people ultimately grounded in the same place is the social connections that they've built there, family, friends, other things. With California, why can't we invest more in the Central Valley? The Interstate 5 corridor is vast as a vast nothingness. But you have Modesto and would be great for investment. What about Modesto? That's going to be the topic of my December talk. What about Modesto? And this is a really good question. And so when you think Kettleman City, who can forget Kettleman? I know these are great, Albert. You're just dropping these economic bombs like there's no tomorrow. I love it. So so when you think about development in the central areas, so the question is, and let's think about this, because that's another question which is really good. How do we stimulate economic growth and prosperity in an area that does not already have it? And so this is actually a riddle of economic development. And so we know for a fact that we need certain conditions in place for economic growth to succeed. We need a solid educational foundation. We need a place that is friendly to workers, families. People want to move there and they want to stay there for a long time and they want to build it there. And also on the other side, you have to have deep entrepreneurial networks to help provide funding, services, allocations, and this becomes really, really hard to build. And so then you have these little incubators across the country that sort of have been seeking this out into varying levels of success. Austin has been particularly successful, but Austin's been working on this for decades, right? So they had their city different. They've been building an entrepreneurial culture. They're able to import a lot of other investors from Texas, as well as nationally. And since then, at some level, it reached critical mass and it continued to grow. And indeed, to your point, Albert, all of these universities are themselves entrepreneurial centers. Fresno State, Chico, UC Davis, all of these institutions. UC Davis isn't so far out of there. Chico is, but I don't know. Just Cal State, Bakersfield. Yes, that's right. Fresno State. You have a lot of universities here with a lot of talent from individual graduates. And the question is how do you get that started? And this has always been the riddle. And so traditionally speaking is that, so you get a job and you look at where these opportunities lie. A lot of cases, the best and brightest collect in areas where best and brightest collect, like Silicon Valley. If you look at a city, for instance, in New Mexico, rural areas get depopulated for the large cities. The large cities are then talented people leave cities like Albuquerque for cities like Denver and cities like Phoenix. And then they leave cities like Phoenix and Denver for San Francisco or LA or somewhere else. And then you have, to your point, other engines of economic growth. Gonzaga, University of Wyoming, Eastern Washington, University of Idaho. You have these universities that are really located in very distant places that haven't been able to, and I'm not arguing this, I was up there, relatively recently in Moscow, Idaho, but it is a very much a college area. It's a college town, right? It's the economic growth. It's in part of that riddle depends on the question of what else is in place. No individual institution, no individual university has within it the ability to carry a community. And we can describe, and of course, we can ascribe so much Bay Area success to entrepreneurs out of Stanford, out of Berkeley, out of other places in the Bay Area that have had this. But it's also the factors that make the Bay Area, the climate, the scenic beauty, what makes people step off a car or out of an airplane, or step out of an airplane, out of a car. I jumped out of an airplane and say, this is a pleasant place for me to make a family. 50s, 60s, 70s, 80s, and those things. And then we saw the expansion of real estate prices and the pricing out of people, especially people who earned lower salaries and represented a lot of face-to-face service work, and how prohibitively expensive a lot of those things have become. And so the question is how can we generate entrepreneurial activity in these areas? And that remains a great uncertainty. You need not just a university or an incubator, but you need a way to establish and encourage development. And so let me bring this up, for instance, right? So when you're looking at questions about looking for investors for your new business, and let's say you start a new company and you're looking for investors, a lot of people who are not located where there's a huge center of knowledge like Menlo Park, and you have a whole bunch of firms located there that can help provide resources, services, and investment, need a lot of help to develop a business plan, to partner with somebody who is not just a distant partner that gives them money, but also provides them connections, right? Opens doors, provides services, mentors the CEO and executives to a level where they can get that product and service to the next level. And this is very much a community sort of organization. You have to have all of these things in place to be an economic driver. And this takes a very long time. And it's very hard to do this. And different places have tried this. In New Mexico, we have two very large laboratories, Sandia National Labs and Los Alamos National Labs. Sandia, of course, has a division in Livermore. But you have a highly educated population, but yet New Mexico has the lowest number of publicly traded firms of any state, which is extraordinary if you think about just the number of PhDs that reside in a state like New Mexico. And so it's not merely the presence of smart people. You need the presence of a structure to help you evaluate risk, develop markets in strategy, and grow firms. And that mix has only been successfully, I mean, there's a few areas where this has been done really well. The 128 corridor in Boston, the Austin area, and Seattle, Portland to a certain extent, San Francisco. And you have these areas which are desirable for those reasons, but the ingredients are complex. And no individual accelerator, no individual entrepreneur network can build those things. But I will say this, the proximity of the Central Valley to established places on Silicon Valley would present it with an advantage. And obviously, the more affordable real estate makes it very desirable for a lot of people to live as families. And you're closer to the mountains. Who doesn't like that? That's very interesting. Anyway, these are really good. That's a really good question about this. We've been struggling with this question for a very long time. The most effective strategies for entrepreneurial growth in a city. And we know that, at least in our current system, the way that we look at things, this becomes a big engine, a driver of economic growth. What do you guys think? All right, so this is, oh, that was fun. I got really separated there. What are economists noticing where people are moving as Austin gets expensive? This is a really good question. So what's after Austin, right? Where are you going next? And so some people have argued it's Nashville. Some people have argued that it's other communities, Denver, Phoenix. Those are also relatively expensive, but cheaper than California in many places. They're looking, and it's much more disseminated. And so if we actually look at, I have a poll data here that I can show you. And if we looked at, say, the best cities to start a business, and this is really weird. So different agencies have different metrics for this. Many argue that the Research Triangle in North Carolina, so that's Raleigh, Durham, Chapel Hill, that area does really well. That ranks highly. Boise, Idaho ranks highly. You have Colorado Springs, Winston-Salem, North Carolina. You have a bunch of disseminate areas, none of which command the dominant presence. And so the thing is less like looking for like your magnifying glasses and finding where is their economic development and why isn't it in Silicon Valley? You know why it's not in Silicon Valley, but the point is still most energy, most synergies still happen here in the Bay Area. And so you still have within that an engine of future economic growth. But I will think, though, it is not a bad thing from an economic perspective to sort of spread in an aggregate sense. Might be bad for individual. If you own half of Palo Alto, and you're looking at those expense, and you want, and it's in your best interest to see increased real estate prices, then you're not going to enjoy less pressure on real estate in certain areas. However, if we look at the way that people act, people move and behave, if economic growth is too highly concentrated, it makes it very hard. It creates resentments, differences, and it creates a lot. Let me back up a second. It creates economic distortions, I should say, in certain areas. And so you have a lot of demand and very limited space to continue to build real estate. And so prices become unworkable in certain areas. For instance, if the federal government, which is highly concentrated in Washington, D.C., in the surrounding vicinity, Northern Virginia and Maryland, right? So the federal government were looking at the expansion of government agencies as a source of economic growth. You would put a government division in a place that is economically depressed, like Cleveland or St. Louis, or Des Moines even, or somewhere else. And you sort of spread around that sort of government work. Maybe the IRS should be located in Fort Wayne, Indiana. I don't know, but the point is you have there can be ways that we're more thoughtful about generating additional centers of economic activity in the country. But sort of we've been very laissez-faire about it. So if I'm betting where people are next, I will view a large segment. So my bet is on the continued dominance of Silicon Valley, followed by a large number of upstart cities, Austin, Miami, Atlanta, the Research Triangle in North Carolina, as well as some other areas taking some of that money, Nashville, even other cities in Texas. That's where the money is, I think. But I still think it'll be far from, like, none of these individually represent sort of a Silicon Valley level of transformation yet. So that's a good question.
Yeah, that makes sense. That's interesting. And so any final thoughts as we conclude on the month of October with David and Joanna here?
Thank you, David and Joanna. You guys are the best. I toast you. This is just water, but I'm toasting you anyway. Thank you.
Well, thank you so much. And thank you for those of us who joined us today. We hope that you're armed with the right information to move forward in your job search.
We have a question from Joanna.
We have a question.
Some people have decided to retire early because the stock has done very well in the past 18 months. That's true. It seems more and more people are talking about potential stock crashing in the near future. What's your take on this? And so, of course, I will have to point out that, of course, I'm not your individual financial advisor and to ask you to look at this from this perspective, but I can talk about it from an individual economic standpoint. That one of the ways we look at these things, if we look at, say, okay, so it's going to boil down to a couple of things. So the first is something that we mentioned earlier in this, called the price to earnings ratio. The price to earnings ratio shows, approximately speaking, it is the price per share divided by earnings per share. When that value is really, really high, the market is considered to be overvalued. When it's really, really low, it's considered to be undervalued. Here's a chart of the price to earnings ratio since 1870. Now, when rates are really, really low, it incentivizes people to invest in things that are a little bit riskier than they might otherwise invest in, like stocks. And when you invest in stocks, one reason stocks have done so well is that there's sort of a dearth of other places where investors can put their money. Bonds, for instance, have really, really low returns. And now that inflation is a little bit higher, to sort of beat inflation on bonds, you're not going to get it from US Treasuries, which are underwater on inflation index bonds. You have to get it from higher risk investments. The greater risk you take, the greater return you get, but also the greater year-on-year volatility you experience. Some years you gain a lot of money, some years you lose. The long-term average return on the stock market from 1926 is about 11%, between 10 and 12 if you use an algorithmic or geometric calculation. And right now, in 2021, you'll notice that, of course, as of like today, the price to earnings ratio in the market is almost 38, which is an incredibly high value from any standpoint, meaning that the price of an average stock across the largest 500 stocks trades at a level that is 38 times bigger than their earnings per share. Normally, in the long run, it's around 20. And so it's not the fault of the market itself, but here's what will change this. The Fed raising rates, when the Fed raises short-term rates, it has an effect potentially to raise other rates across the system, not only across treasuries, but also it raises rates on bonds, on debt, on other things. Investors will start shifting money potentially away from stock markets into other places like bonds and other things. And so when we look for things or anticipate corrections in the marketplace, often they're unpredictable. We can't tell you tomorrow if there's going to be a 10% drawdown or 20% drawdown. But there is things, it is certainly a very expensive market by most standards. And it is worth caution. But the point is that there are a few, and I wouldn't advocate, and I would speak to RA about this, putting everything in treasury bills just yet. But be careful about the way you manage your risk return, your investments over the next year. Be careful about how you manage your investments, particularly as the Fed signals that it might be raising rates as early as next year. And when that happens, that might be a catalyst for a stock market decline. And I think it is within the bounds of any cyclical long-term institution. It is inevitable that this will happen. Now, that said, is it possible the price earnings ratio will hit 45? Possibly. Maybe it'll be as high as it was back in 2000. But also, it's possible that it might just remain, that it might correct at some time soon. The key on these things is notice the slope, right? When rates are lowered and more people invest in the market, you get sort of this very maintainable slope where price earnings ratios increase. Then there's an unmaintainable bubble followed by a crash, and then another crash in 2008, followed by an average slope. And so it could easily just fizzle out in a very gradual way if the Fed is cautious about raising rates over the long term. But that said, is that in any market, good or bad, there are always good investments that you can make. And I do encourage you always to research as much as you can about any of these things. I love it, Joanna. I love that question a lot. So the market is, in short, very expensive, but there's a lot of things going on. And we have
new people. New people who just joined us just as we ended. But welcome nonetheless, Jimmy. We appreciate you coming in. I think it said 5 o'clock on the on it, but that's interesting. Let me see. What did it say? Yeah, it said 5 p.m. So you can catch the recording later. 9 p.m. Eastern. Okay. All right. Well, we'll. Do you want to give a quick summary, Reilly? I guess we're still here, so. Should
we do it again? We can. Should we do it again? We can do it again, Albert. I'm kidding.
Yes, we will send you a link to the recording, and we'll go from there. And these are always 5 p.m. on the first Friday, with some exceptions if Dr. White can't make it. But yes, in November, we're going to talk about a topic that is near and dear to everybody's hearts, which is why it takes so long for you to get those things you ordered online many, many weeks ago. And so we're going to be talking about the supply chain crunch, what that has to do with the holiday season, and how that might affect your job search as we go along. And so I know, Dr. White, you're going to have thoughts and words around that, and we look forward to hearing them. Until then, we will talk to you all later. Bye, everybody.